Hello and welcome everyone to the William Buck Federal Budget Debrief for 2023-24. My name's Todd Want and I'm pleased you could join me. I'm joined today by my colleagues Chris Liu and Nicola Bird, and we'll take you through all things federal budget as they relate to the mid-market. I'd like to commence the webinar today, though, by acknowledging the traditional owners of the land on which we all meet. I'm on Gadigal land, but for all our attendees, you'll be on a variety of different lands, and we all pay our respects to the elders past, present, and emerging. During today's webinar, if you do have a question on some of the topics, we will look to draw those out during the presentation. But if you do have something that's a pressing question, feel free to raise it in the Q&A function, and we'll endeavour to get to as many questions as we possibly can during the webinar. So today's session, we're going to work through a variety of things, and the federal budget certainly did cover a variety of aspects. What was clear from the budget was that we actually have a surplus. For the first time in many, many years, the budget for the current year, not for the future for the 23-24 year, but for 22-23, looks like it may well end up in a surplus. Now, it may be a very thin and small surplus, but it's a far cry from where we sat a bit over 12 months ago when the 2022-23 budget under the former government was handed down. We look at the anticipated net debt for Australia. At 30 June 2023, it's around $550 billion it's anticipated to be. If you went back a bit over 12 months ago to the March 22 federal budget that was handed down, it was anticipated we'd have over $700 billion of net debt at the same time period at 30 June 23. So you can see there that the federal budget position over the last 12 months is about $160, $170 billion better off than where it was anticipated. Now, as a country, that's a really good positive thing. Obviously, it has a knock-on effect that it reduces the interest that as a country Australia has to pay on its borrowings, but also it means that there's a better budget position for other measures. And those other measures, some of which the government announced, were relief from cost of living pressures. Those type of things, there's perhaps a little bit more room for the government to implement those style of measures. Now, the growth, the real GDP growth that's anticipated. Current year, 3.25%. Next year, 1.5%. If we contrast that to where we were at, in the federal budget 12 months ago, similar position for 2023 year, but we are anticipating, or the government certainly is, a slightly lower GDP growth level for 2024 year than what they'd anticipated a year ago. Move on to unemployment rate. They're anticipating it's still towards those record lows of around 3.5% for the June 23 quarter, but pushing up so that in a year's time, up to 4.25% unemployment. We contrast that to where the budget 12 months ago or 14 months ago was anticipating. It was looking at around 3.75% for both the current year and for next year. So you can see there that the way the economy has evolved and the world has unfolded in the last 12 months, the pressures through interest rates in particular and cost of living, job losses or people not perhaps working or looking for work but not in paid employment, they're anticipating an uptick over the next 12 months. Inflation's probably one of the interesting factors that obviously we're sitting at a reasonably high level relative to where most of us have been used to for quite some time, that the federal government's anticipating that at the June quarter this year, year to year from June last year, a 6% increase in inflation, but then through a number of measures, including some of the cost of living pressures measures that they've implemented, they're anticipating it to drop back to a bit over 3% by the time we get to June next year. Obviously, when the federal budget was handed down 12 months ago, they're anticipating a more stable inflation environment. And as we've all seen, that wasn't what reality played out as. And we've had a much higher spike in inflation over that 12-month window. But the government's certainly anticipating that their measures will contribute to a reduction in the inflation rate for the next 12 months. So that sets a bit of a scene for where we're at overall in a budget position. If we move on to some of the areas that either had or didn't have as perhaps more notable major changes. If we look at individual tax rates, there was absolutely no change. The rates that we are used to for the current year, the marginal tax rates, they're remaining the same for next year. There's no change announced to them. The only couple of things to be aware of, there was a small increase, as there tends to be every year, in the Medicare levy low income thresholds. And that obviously impacts the lower income earners, in a positive manner by allowing them some relief from Medicare levy. But the one notable thing that I think a lot of the press has focused on in recent weeks and months is the Lamington, the low and middle income tax offset. Someone's gobbled that Lamington up and it's gone. It was only ever introduced as part of the progressive adjustments to the individual tax rates over a number of years. That was a tax offset, as the name suggests, for low to middle income earners. It got extended during the COVID period as a way of putting more money into the pockets of low to middle income earners. But it was always slated to go as part of the changes to the individual tax rates. The government haven't announced an extension of it or a reintroduction. It's gone, and so we move on from that. Probably more notable was some of the commentary or certain areas saying, well, the stage 3 cuts to taxes. And those were the ones focused on middle to higher income earners, whereby the tax rates were being flattened so that for the vast majority of people, their earnings would be taxed at a 30% rate. So for those with a taxable income of between $45,000 and $200,000, you'd be subject to 30% tax. And also the stage 3 tax cuts were to introduce an increase in the threshold from $180,000 to $200,000 before the top marginal rate kicks in. That legislation was pushed through by the former coalition government. That legislation is locked in. It has been for a period of time now. The budget did not announce any changes to that. So as we stand today, there was no measures to try and unwind that or change that. This is slated to kick in from 1 July 2024. So importantly, I think for a lot of taxpayers, no change. So is that a good thing? Well, we'll talk through some of the other budget measures to see where the funds have or haven't been spent. Now, while we're on the individual market, there's some more money thrown at the tax office and treasury. Now, that's a pretty standard thing in the context of what governments of the time do, is they're always looking to give the tax office further resources to go and hunt down more revenue. And usually they're looking for a decent return on investment, like all of us as business owners or advisors are looking to do. If you're spending money, you want to get a return on it. In this instance, they're looking at about a 5-to-1 return on their money. The government's anticipating throwing about $90 million of extra funding towards the tax office and treasury for personal income tax measures, and they're estimating that they'll collect around $475 million in extra tax revenue. Now, the key focus of this funding is for non-compliance and emerging areas of risk. Now, non-compliance is probably, as the term suggests, fairly general area, and the budget papers didn't give a great lot of detail on what that meant. But the emerging areas of risk is an interesting one, in that they specifically named one of those emerging areas as being deductions relating to short-term rental properties to ensure they're genuinely available for rent. So what it means is, watch out if you've got a holiday home or short-term rental that you're claiming deductions on. Now, why it's significant, the short-term rentals and the genuinely available for rent. If you've got a property that is rented out or available for rent as a long-term rental, it's much clearer that it is an investment asset, because you're looking to earn rent or income from it year-round. And therefore, the proportion of deductions you should be entitled to, you'd be anticipating is 100% of your eligible deductions. Whereas your short-term rentals, where it's, say, a holiday house or a property that you might put on an Airbnb or a similar platform, but you also might go and stay in it, so it might be your family holiday home, are you claiming the correct proportion of your tax deductions? So just because you've rented it out or had it available on a platform for rent for the whole year does not automatically mean that you can claim 100% of the expenses that you've incurred in relation to it as a deduction. So different proportions may apply, and often that is based on whether it is genuinely available for rent. And what that term means, it needs a context. So have you priced the property appropriately that you're still going to have people wanting to stay there, or have you overpriced it so much that no one's going to stay there and therefore it's not really available for rent? You're just trying to put it up there to claim some tax deductions. So that's an area that evidently the government thinks they're going to collect a fair whack of revenue from it over the forward period here. So that's one to note in the individuals market. Now, from an individual's point of view, there wasn't a lot of tax-related measures. They were, as we said, what was not put in there, the tax rates and that not changing. But a lot of it was the cost of living measures that are not tax policy. They're just assistance with, say, energy bills and that type of thing, which are a broader policy measures. But what has been a part of the federal government's core policies from a tax perspective was changes to superannuation. And there's a couple of notable ones that are very significant for many people, or very significant for the future planning and approaches that people will take to their attitude with superannuation and retirement planning. So I'm pleased to have one of my colleagues, Chris Liu, who heads up superannuation, to join us today and to discuss what these measures actually mean for mid-market clients. And some of them, yes, they've been in the media for a few months, but there was obviously some further details and that's announced in the budget or further clarifications. Paris, hand over to you.
Thanks, Todd. And so we're going to start off with the elephant in the room, if you want to call it that, which was announced a couple of months ago now. And it's really that reduction of those tax concessions for superannuation balances above $3 million. And so just to take you on that journey about what this measure entails, and as you can appreciate, this has been in the media for a little bit of time, so you may have read about this already. But fundamentally, it's looking at your total superannuation balance, which is effectively the aggregation of all your superannuation across all types of super funds, no matter whether they're in, say, a self-managed super fund or whether they're in those larger funds, and aggregating the total value of that. Ultimately, what this measure is trying to do is effectively look at whether you have a total superannuation balance at the end of the financial year in which it is measured, whether it exceeds that $3 million balance, and anything proportionately above that and the earnings attributable to that balance above $3 million would get an additional 15% tax on those earnings. Now, we're going to go through just some key concepts in the interest of time for today to just talk about what this measure entails. But a couple of things to note. This measure is still, there's no legislation that has been released, and if anything, government has reconfirmed it as part of the budget announcements last night. So they are proposed to take effect from 1 July 2025. And what this practically means is that really the earliest time that you'll measure this total superannuation balance for a particular person like yourself is at 30 June 2026, which means that we're not really looking at these tax implications until post 2026 financial year. Now, remember that we're measuring total super balance at the end of 30 June, which is whether we've got $3 million or more at that point in time. And again, can't stress enough that we're looking at the proportion of earnings relating to the balance above $3 million. So it's not the entire amount of earnings that have been attributed for the entire financial year. Now, a couple of things to note with these measures. Negative earnings. So if you do have received a negative earnings amount, they can be carried forward and offset against positive earnings in relation to this measure moving forward. But it's really important to note here that it only can be applied against those particular positive earnings relating to this particular measure. And then finally, the tax can actually be paid by the individual in their own capacity or by a superannuation fund. So you can actually nominate the super fund to pay that tax. And for those of you who may be familiar with Division 293 tax, it's planned to operate in a similar fashion. So when we're looking at all of this, there was a fact sheet that was released a couple of months ago now, it's probably 3 months ago now, and then there was a Treasury consultation paper that provided a lot of guidance and examples about how this measure would operate. Feedback for that closed actually last month on the 17th of April. And so it is fitting to sort of talk about really how this is really going to be calculated, because if anything, the budget papers actually confirmed that this was actually going to be how it would be effectively introduced as draft legislation if it does go ahead. So really there's in terms of the calculation, there are really three broad steps. The first one is calculating earnings. And you'll see here, based on the gibberish on the screen, this is taken directly from those consultation papers originally. But you can see here that TSB stands for total super balance. And when you look at this calculation, you can see it's really a deemed earnings calculation. It's not actually factoring actual earnings that have been received during the year. So it's looking purely at the total super balance for the current financial year. So at 30 June, say 2026 would be the year in which it is proposed to commence, less the opening balance, or basically the previous financial year's total super balance, adding back withdrawals and taking off net contributions, so net of any tax. So you can see here that that really does incorporate unrealized capital gains, and we're going to discuss that a bit more in a little bit of moment. So with step 2 here, we're going to look at the proportion of earnings, and really you can see here that it's factoring in just the proportion of the balance that exceeds $3 million, and we're going to go through an example in a moment to illustrate this a bit better. And then finally, it's to calculate the tax on this. It's simply taking the earnings, so this deemed earnings calculation, multiplied by the proportion of earnings above $3 million, and then multiplied by 15%, which is this additional tax liability. Now, it's important to note here with a lot of this that the current rules regarding taxation of superannuation are not changing. So potentially your super earnings are taxed at 15% or less, depending on whether it's an accumulation or pension phase or a hybrid of the two. And this is really an additional tax on top of that. So let's just go through a bit of an example. If I've got Bob here who has a total super balance and he has $3 million at 30 June 2025, but $3.5 million it grows to by 30 June 2026. So if we're putting these real numbers as an example for how these measures will apply, let's say he withdrew $100,000 because he was eligible to, but he was still eligible to make some contributions. Let's say $27,500 of concessional contributions, and so the net contributions are $23,375. So again, if we just go through these steps one by one, first thing is to calculate the earnings. So you can see here it's simply just taking your total super balance for the current year less the $3 million, add back withdrawals and take off the net contributions. So I've got a deemed earnings calculation of $576,625. Again, we take step 2 here and we look at the proportion of earnings. So we're looking at the current total super balance less the $3 million balance. And anything above that, I'm taking that percentage over the 3.5, so it gives me 14.28%. And then simply step 3 here is taking the two values that we've just calculated multiplied by 15%. So that gives me a tax liability of $12,351, which is on top of the, like I said, the normal tax liability that super fund would ordinarily pay. So when we get to all of this, we're thinking about, what are really the key issues here when we're looking at practically, what concerns do we have regarding these types of superannuation balances, and what things should we really be considering in relation to this? And so I'd like to invite Todd back onto the call as we discuss these things. I guess the key thing here is about these unrealized earnings that are being incorporated into this deemed earnings calculation, particularly unrealized capital gains, and when we've got those sorts of lumpy assets. That really does cause some issues here, and unfortunately the budget papers didn't really address this, even though there was a lot of feedback, I suppose, from industry and particular people across the country voicing their concerns about these unrealized capital gains.
I think that's, Chris, that's probably the number one thing that people are most frustrated with or annoyed with or concerned about with this particular measure is the unrealized capital gain. And what that means for holding assets through super, what it means for having to pay tax when it doesn't match the actual realization of a cash event. So if you're holding an asset and it's gone up in value, it doesn't mean you've got any extra physical cash in your bank account. You have an asset that based on its value is worth more to you than what it previously was. But that doesn't mean you've got the funds there to pay the tax. And that's where a lot of frustrations have come in to this process. And whether the $3 million is the right number, the wrong number, whether the measure is right or wrong, this is probably the number one thing that people are frustrated with. And it does have a broader ramifications that under the tax system, if you own assets outside of super in, say, a company or a trust or that type of environment, and it's an asset on capital account, you're not taxed on unrealized gains along the way. You're taxed when you realize them. When you actually trigger the CGT event, usually that will tend to be, excuse me, when you go and sell the asset. So this is really an important thing and a planning thing for clients. But Chris, obviously the measures are not kicking in straight away here. And that's something probably for people to be well aware of.
Yeah, that's absolutely right. So it's not appropriate, as opposed to go rushing to do things without at least seeing some legislation. But certainly when we're looking at this measure and what is about to unfold, it's worth having this in the back of your head as you're discussing or considering planning ahead, especially over the next couple of years, about where it might be suitable to potentially hold particular types of assets, and how they're actually held, and potential, as we've got on screen here, cash flow issues for whether it's the member or the super fund, and what might be suitable for you and your private group, for example. And on that note, if we continue this discussion and we talk about the potential things that these negative carried forward earnings, unfortunately, the way that it is to apply is it can only apply to, any positive earnings in relation to this particular measure, so that it can't actually be applied to any other type of tax. And so there are a real issue here regarding super funds who are unable to recuperate these losses if they have negative earnings and potentially carry this forward indefinitely. So it's something to be mindful of when we're thinking about this particular measure. And then, as Todd, as we're just talking about, really having a look at structuring estate planning and particularly asset valuations when it comes to this particular measure. I can imagine that valuations are going to be quite critical when we're trying to work out what the value is at 30 June of particular relevant years. Potentially, there's going to be a lot of pressure on, say, independent valuers who are going to value particularly real property, for example. But it really is going to play a real big importance on how we actually structure things and whether superannuation is the appropriate vehicle to be holding particular types of assets.
That's right. I think there's been, certainly for mid-market clients that have looking to build up some of their wealth through a superannuation account, particularly through, say, a self-managed super fund, a lot of those business owners look to buy their business premises through super, or at least part of their business premises through super. And whilst obviously they need to get the appropriate advice based on their circumstances, for many people that ends up a very, very sensible strategy and a way of accumulating wealth. And then when they reach the back end of their business career, they'll either sell down the property or they'll keep the property, sell their business, and live off the rent from that property. And that's what ends up paying, say, their pension from their super fund. Now, that works really neatly for a lot of people, but this measure, what happens if your business premises happen to be located in an area that gets rezoned? What happens if it's farmland that's rezoned to something else, but you're continuing to use it for the use you always have? So you might be in a fringe area where you've always kept the property, it's been, say, an industrial property. You've always used it for that purpose. You intend to use it for that purpose, but perhaps the zoning's changed, which has increased the value of that asset. For many people, that may lead to the value of the asset on paper increasing, but they have no intention of actually selling that asset in the short to medium term. These measures might force their hand, that if the superannuation balance exceeds the $3 million and they're suddenly subject to a bunch of extra tax on unrealized gains along the way, then is the benefit of retaining it in super still there? But probably, as you say, Chris, the more pertinent question here is, will this fundamentally cause a shift in the way assets and asset holdings are structured and the type of assets that people retain in super? Now, obviously, people should be getting appropriate advice on their circumstances from their financial advisor. But in terms of what this may do from a structuring point of view, if people are subject to, say, a 15% tax on their core superannuation earnings, and then a further 15% tax on under this proposed measure, then will that encourage people to put less into super? Will they hold more assets through discretionary trusts, through corporate beneficiaries, through their companies, outside of super, more things in their personal hands? What will this do longer term on structuring and the decision making? And as you flagged on the slide here, Chris, the estate planning for clients and where they head with their kind of core of their wealth in their structure. A lot of people aim to push their core wealth into super or their main residence with perhaps a small amount in their own hands once they've reached retirement age. Will this cause a shift in that mentality? And what does that do for broader estate planning? This measure goes far beyond simply raising some additional tax revenue. This is a fundamental shift in the way super is thought of. By no means does it make super unattractive. It just makes the decision when comparing the tax outcomes to other structures far more complicated and far more specific to each client's circumstances than perhaps what people would ordinarily or historically have done on first blush to say, oh, super is fantastic. We're not saying super isn't going to still be a fantastic environment moving forward from a tax perspective, but it does have some additional complications now.
Yeah, absolutely. I think it just simply changes the dialogue. And yeah, as you've mentioned, Todd, it does have some further ramifications, far more far-reaching than super itself. If we continue on with the super measures, particularly the ones that are impacting individuals, and here we're looking more at superannuation funds with the self-managed super fund kind. And for some of you who may be familiar or may have joined this journey over the years, non-arm's length income is effectively a penalty tax that applies to certain types of income where it's of a non-arm's length nature. So meaning that it is higher than what the super fund would ordinarily have expected if it was dealing on an arm's length basis with another party, in particular with transactions. And so just to provide a little bit of context with this, normally super funds are concessionally taxed at 15% or less, depending on what phase the super fund is in or the balances that thereof. And so when it comes to non-arm's length income, and hopefully no one on the call actually falls foul of this, these rules effectively are a penalty rate, potentially taxing at the highest marginal rate of 45%. And from 1 July 2018, there were some major changes to the rules regarding non-arm's length income that could potentially taint all of the super funds income based on a few particular positions that the ATO had taken in relation to these measures. And so that effectively caused a lot of uproar in the industry about how it was actually going to be dealt with. Now, fast forward to today, and there has been a lot of consultation regarding those measures and the interpretation of that. And so what the budget papers really did last night was they tidied up, or effectively put some proposed changes to tidy up last year's announcements and actually make things a little bit more defined and effectively to reduce the potential impact and not allowing the entire fund to be tainted because of these non-arm's length income rules, or as we like to coin them, NALI. So the potential proposal is to cap the actual exposure, not to the entire value of the fund's income, but ultimately just limiting it to twice the value of an expense when there's general expenses involved, and where these general expenses are of a non-arm's length nature. Ultimately, as well, they're proposing to remove large APRA funds from these NALI provisions in relation to general and specific expenses. So those large APRA funds are definitely happy about that. Unfortunately, it is still going to apply to self-managed super funds and smaller APRA funds. So it's really important that if these measures are coming out the way that they are proposed to, that they are still going to apply to those smaller superannuation funds. And finally, they're actually going to cap when it's actually going to apply to and what types of expenditure it's going to be exposed to. So from 1 July 2018 onwards is when it's actually going to apply, and it's not going to apply to expenses prior to that period. This is actually of a quite technical aspect, so please reach out if you do have any specific questions on this measure. I would like to now just move on to employer superannuation. And as you may have read in the last couple of weeks, the Treasurer actually released a little bit more information about this proposal, and we'll talk about this now in a moment. So firstly, before we get into the proposed changes, the first thing, Superannuation Guarantee. This is still continued to set to increase to 12% progressively. And so by 1 July 2025, we're going to be at 12%, currently at 10.5%. And importantly, from 1 July 2023, this will increase to 11%. So again, for all of you who are business owners or employers, it's important to make sure that your software and everything is on point to actually take into effect this change from 1 July 2023. So this is still scheduled to go ahead. But the proposed measure is really this payday super, if you want to call it. Official budget papers called it something else. Right now, employers are required to pay superannuation on a quarterly basis. So we've got these quarterly periods, and it's really due the 28th day of the following month in which the superannuation is actually due. But the proposed changes are planned to take effect from 1 July 2026, so we're still a few years away. And ultimately, it's just trying to align when superannuation contributions are made by employers on the day that salary and wages are paid, so basically on payday. So critically here, we're looking at timing of these contributions and when they're actually paid, and the reasoning behind the delay in actually putting these contributions or these measures in place until 2026 is really to allow employers, business, ATO, and all the payroll software and the like to actually put in place these changes so that they're ready to rock and roll by 1 July 2026. The other thing as well to note on the back of this is that there has been legislation that's been introduced as of last month just regarding enshrining the right of superannuation payments for employees. And so it's really government's intention to put a lot of emphasis and focus on superannuation and making sure that employers are making their superannuation guarantee entitlements for their employees. That idea of compliance is really important to both Treasury and the ATO. There is so much lost super nowadays. And I suppose, Todd, if we're talking about this an employer super, really it's important now, I suppose. It sounds like it's going to be an intended measure coming up, and government are certainly pushing for this, making sure that employers are making their superannuation guarantee contributions on time. There was an amnesty that was introduced a few years ago, which really placed importance on super by employers. And the penalties are high and the penalties are harsh for those employers who don't make those contributions on time. So again, it's really important for businesses to make sure that these measures are addressed and that the appropriate mechanisms are put in place so that super is paid on time.
Look, it's definitely one that the vast majority of businesses do the right thing, and they pay their super for their employees, and they pay it by the due date. But there are those businesses that don't do it, and there was also a practical impediment for the payments of this historically, that if you were doing it on payday for every employee, the sheer administrative burden of dealing with it would arguably outweigh the benefits, or it would add an additional layer that that complexity would be significant. Now, with things like single touch payroll, with the employers having electronic software and mechanisms in place, that impediment is largely managed. It's now down to things like cash flow. And for many businesses, whilst they are always doing the right thing as far as paying by the due date, the fact that they will need to pay employer super on payday, and then the fact that it has gone up from what was 9% not that many years ago, and remembering that super first, when the measures were brought in the 90s, started at 3%. It's gone from 9% in recent years right through to heading to 12% over the next couple of years. It's a material amount. Now, yes, it is an employee's entitlement and under employment law, but that's a significant financial amount. So the cash flow implications for businesses can't be understated. And the practical mechanism of managing this, and Caris, in terms of when super is considered to be paid, current interpretations aren't necessarily based on when the employer physically pays the amount. It's actually when the super fund receives it, in many instances for many tax and super measures. So absolutely, on payday here, how are they going to deal with the legislation? Because just because an employer might pay it on a particular day doesn't mean the super fund will receive it that day. So what sort of scope they're likely to have in these measures? I think, Caris, they've announced last night that there will be a consultation, and they're anticipating that next year's federal budget is when they will provide more detail on this particular payday measure.
Yeah, that's right. And certainly with single touch payroll and SuperStream and all the, I suppose, the technology advances in relation to superannuation, they're certainly cracking down on this. The visibility for both employees and for the ATO is going to become really easy. And so we expect that, this will be hopefully it really is fundamentally a positive change for employees, but may present some challenges for businesses as they adjust to this particular measure.
Yeah, and I think it's worth noting here that a number of the questions that have been coming through from people, and if you do have questions, please feel free to keep them coming through. We'll do our best to address as many as possible. The core of a lot of the questions that we've had are around more detail on these measures, both this measure with the Payday Super and also the measure with the $3 million cap for super, after which people will pay an extra amount of tax. The reality is there's not huge amounts of detail. We don't have legislation on either lots of measures. And in essence, what Carissa's taken people through on this webinar today, that's kind of the extent of the detail on the measures. The formula for the $3 million extra tax rate for super, that formula is the core of the government's announcements and papers that have come out. The legislation is not there. So many of the questions people have been raising around other taxes and that, other taxes are not proposing to change. They are there, they will continue to apply, and there is no fundamental change proposed to how they will apply. These measures are in addition to it, or the Payday Super is bringing forward the date that super would otherwise currently be payable. So, Carissa, I think superannuation, did you have any other comments you wanted to make before we move on to other business measures?
No, not at this point, but just, I guess, watch this space. And as Todd's alluded to, wait for legislation, I think, because that will provide a lot more clarity as we look at the years ahead, and it will allow us to plan a little bit better in relation to looking at how this can interact with both super as well as your broader affairs.
Yeah. All right. So, moving from the employer super measures into broader business measures, and we're back to the future. For depreciation, we are back to the future. For many people over the last couple of years, depreciation has been a word that they haven't been bothered with. Well, certainly from a tax point of view. If you're doing it from an accounting point of view, yes, it may still have had its relevance, but for tax purposes, you've had the instant write-offs, the temporary full expensing. Those measures come to an end on 30 June 2023. And that legislation has not been kicked down the road or extended. So 30 June 2023 is actually a very critical date. And what's really critical about it is that if you're looking to avail yourself, your business is, of these instant write-off temporary full expensing that applies to businesses of all shapes and sizes and asset purchases of all sorts of amounts, you need to make sure that that asset has been purchased and is installed, ready for use by 30 June 2023 if you wish to get that instant deduction in the current year. From 1 July 2023 onwards, the size of your business and the purchase price of the asset will become very relevant as to what depreciation measures will apply for tax purposes for your deductions. So, small businesses. Now, what do I mean by that? Well, the government have said that small businesses are those with an aggregated turnover of less than $10 million. Now, the aggregated concept is an important one because it includes the group of entities that you are part of. So if the business is run through a company and there are other companies or trusts or the like in the group that carry on business, you will likely need to aggregate or add together their turnover to see if the business is under the 10 mil threshold. So this will mean that quite a number of mid-market businesses may not qualify for the measures that apply to small businesses. So hence why I said the depreciation rules that apply today are quite different to what will apply from 1 July 23 onwards. So for small businesses, they're back to the instant asset write-off for assets costing less than $20,000 per asset. But interestingly, the budget papers only introduced this measure for 1 year. This was not a permanent introduction of a $20,000 threshold. It was a 1 year thing. So no doubt, if we're following history of what different governments have done, We can wait for next year's federal budget to see what the depreciation measures will be yet again. But here, from 1 July 23, small businesses that acquire an asset, $20,000 threshold, so less than 20,000, instant depreciation on that. Pooling is back. So if you're a small business and you buy an asset that's cost 20,000 or more, you can pool that. And by pooling, I mean you pop it into a depreciation pool, get 15% depreciation on the asset in year one, 30% each year thereafter. For other businesses that don't meet that small threshold, you're back to the old standard depreciation rates, depreciating it based on what the asset is and its effective life over time. Low value pooling is back. So many of you might recall that if you're in business prior to kind of the COVID times, that if you bought assets that had a lower cost, so under the $1,000 mark, you could pop them into a low value pool, which would effectively depreciate at 18.75% in year one and 37.5% each year thereafter. Small business energy incentive. Now, this is one for small and medium businesses with an aggregated turnover of less than 50 mil. And what this is designed to do is provide an additional deduction of 20% of the cost of eligible depreciating assets that support electrification and more efficient use of energy. Now, what it will allow is up to 100,000 of that total expenditure to be eligible. So a maximum eligible additional deduction of 20,000. So basically, on top of whatever depreciation measures you might get, an extra deduction of 20% for those eligible assets. So some examples they put in the budget papers: energy efficient fridges, heat pumps, electric heating or cooling systems, batteries, thermal energy storage, those types of things may qualify under this measure. It will be for those assets that are eligible and they are installed, first used, ready from 1 July 2023 to 30 June 2024. So again, a 1-year measure. But we don't have full details. They're going to go out for consultation. Presumably the consultation will be fairly quick, so that people have got that full 12-month window to fully understand the measures and apply them. But they have said that notwithstanding the fact that it's going to consultation, exclusions will apply for things like electric vehicles, capital works, renewable electricity generation, and assets not connected to the electricity grid and use of fossil fuels. So it is a measure to try and encourage the electrification of things. And many of you may be aware that there's certain FBT favourable treatment for electric vehicles that businesses may buy. This probably is a natural extension of that theme of encouraging appropriate use of energy, and in particular, this measure is targeted at the small to medium business market. Now, also in the the core small to medium business market here, tax instalments. If you pay PAYG or GST instalments using the ATO instalments, they're reducing the adjustment factor. So theoretically, that will mean that you're paying a little bit less along the way in terms of PAYG or GST, which should help your cash flow. It might mean at the end of the year, there's more of a catch-up payment for them. So it's not a permanent reduction in the amount of tax you're paying. It's just a timing thing as to when you're required to pay it. Interesting little note buried deep in the budget papers was that the government's proposing from 1 July 2025 that small businesses will have up to 4 years to amend their tax returns. Now, currently, many or most small businesses might only have a 2-year window. Now, that can be a positive thing, that after the 2 years, unless there's been some behaviour that's perhaps questionable, the ATO is out of time to go and amend your return. But on the flip side, if you discover after 2 years that you've made an error and you want to go and claim some extra deductions or something like that, you're generally out of time as a default position. It would appear as though they're going to allow small businesses that bit of extra time to go and amend their tax returns. The measure was silent on whether that also means the commissioner can go and audit you for the 4-year window, but presumably if it's a positive measure, it's designed to not give the commissioner an extra couple of years to go and audit and amend you. And there's also a small business amnesty to give some lodgement penalty relief for small businesses that are trying to catch up and re-engage in the tax system, where during the period 1 July 23 to 31 December 23, They're catching up on tax statements, be they BASs or other types of things, that were originally due between 1 December 2019 and 29 February 2022. So essentially during that core COVID window where businesses focused on other things than perhaps their tax lodgements, this is trying to encourage them to re-engage with the tax system. Now, on that note, that's kind of the core, the SME part, but by no means is that the only part of the tax law that is relevant for SMEs or broader businesses. There's certain other measures that relate to corporate and internationals, and many of the measures on first blush might apply to large end of town, but do have significant relevance to many Australian-based organisations that might be part of a broader worldwide group. So to tell us more about this, I invite Nicola to join us, who specialises in this sort of corporate and international tax area.
Thank you, Todd, and good morning to you all. Thanks for joining us this morning. So as Todd mentioned, I'm going to be discussing some of the remaining sort of apply more to Australian businesses or Australian businesses or Australian corporates that are part of larger multinational groups. Now, the first one that I wanted to Sorry, my Zoom just quit unexpectedly. Can everyone hear me? Okay, so the first measure that I wanted to discuss is related to the OECD Pillar 2 framework. Chris, if you wouldn't mind just skipping ahead, there we are. Okay, so essentially, as Todd said, what we've sort of seen here is this is part of the government's initiatives to make sure that these large multinational groups are paying their fair share of tax in Australia. Now, the OECD Pillar 2 framework, this is an international tax measure as was developed by the OECD. And it applies to essentially to large multinational groups where they have consolidated revenue exceeding 750 million euro, which is around the $1.2 billion mark. Now, the purpose of these rules broadly is to target pockets of untaxed or undertaxed income that are present in multinational groups, which are seen more and more frequently as a result of the digitalization of the economy. And how the measures seek to address this is they impose a 15% global minimum effective tax rate to these large multinational groups to ensure that overall from a group basis, they are paying tax at a minimum effective tax rate in all of the jurisdictions in which they operate. Now, there are three key measures that are going to be released in 2 stages. So essentially, the first measure would come into effect 1 January 2024. And this is essentially targeting Australian parent entities of large multinational groups. Now, where you look at the parent entity and their effective tax rate on a global basis, if their effective tax rate is not 15% or more, the Australian parent entity will essentially be liable to pay a top-up tax amount such that the effective tax rate of 15% is achieved. The second rule, which is effective a year later, so 1 January 2025, this is an expansion of the rules whereby Australian subsidiaries of large multinational groups may also be liable to pay a top-up tax in Australia, where the 15% minimum tax rate isn't achieved at the parent level under that first measure. So that could be, for example, where the parent entity might be in a jurisdiction that hasn't yet introduced these rules, so they don't pay the top-up tax, where the global effective tax rate then remains under 15%, that under-tax component of the revenue is identified, and those profits are essentially shared between the remaining entities within the group based on a formula, and all of the entities would pay this top-up tax on that. And then the third measure, again, which is now coming into effect in 2024, is the imposition of a top-up tax for Australian entities specifically. So this could impact on Australian subsidiaries of these large groups where they themselves do not have an effective tax rate that exceeds 15% in Australia, then they would also then be liable to pay a top-up tax locally to get their effective tax rate up. So that was the first measure that's come through. As I mentioned, it's an OECD measure. So there are many other jurisdictions that will be introducing rules such as these, and Australia essentially, we're seeing these now come through. As you probably may have noticed, if you are, if these types of international tax matters impact your business, there has obviously been a move, and there've been a number of other measures that were released in the past 4 months that would also apply. So it is a large, you can see, initiative of the government to be looking to ensure that these multinationals are paying the right amount of tax in Australia as well as globally. So coupled with this expansion, there was also an expansion of the anti-avoidance rules. So broadly, again, historically, the Australian anti-avoidance rules have been very Australian-centric. So they've focused on, where there is a purpose to obtain an Australian tax benefit, or there's, reduction of Australian taxes, then we have these general anti-avoidance rules that apply, or that could apply in this instance to reverse any of these tax benefits. What we see now through the expansion, which really, of these rules, which was announced last night, is to try and level the playing field to say, well, to the extent that there is an international tax avoidance purpose, arising, our rules under the Australian domestic rules could impact all these arrangements as well. So the first measure, or the expansion that comes in, is applicable to withholding tax rules. So essentially, the avoidance measures as they currently apply to withholding tax would only apply where there is a taxpayer that is not liable to pay withholding tax on an amount. Under the expanded rules, this will be expanded to include where there is actually withholding tax is still paid by an Australian entity on payments that it makes offshore, such as dividends or interest or royalties. However, they have achieved a lower withholding tax rate. So if there is essentially a key tax purpose in paying a particular jurisdiction, because let's say they have a more favorable rate of interest withholding than another jurisdiction, these rules, these type of payments now would be falling within the Australian anti-avoidance measures. The second one then is expanding the purpose test. So currently, how the anti-avoidance rules apply, they would target schemes where the dominant purpose is to obtain an Australian tax benefit. Under the expanded rules that were announced last night, you will see now that our anti-avoidance rules can apply to schemes where the dominant purpose is to obtain a foreign income tax benefit, or to reduce foreign income taxes, where there is then also an ancillary Australian tax benefit as part of that scheme. So overall, you see an expansion of these rules, which is, again, not untoward, because if you would understand, or if you've sort of been looking at what's happened over the past couple of years, the multilateral instruments, which essentially were a suite of measures introduced over the past few years, whereby Australia could amend its tax treaty network. A lot of these measures have actually already been introduced into some of Australia's tax treaties. So they've already been there. They've already been measures that we would have been needing to consider. Now they've just sort of aligned the domestic tax rules with also the international tax norm, essentially. Good, yeah, that would be then the MLI up there. So moving on to the next slide now. So what I'm going to discuss now is just some of the other business measures that were announced, which haven't already been addressed by Todd or Chris. So the first one of those is that there was a previously announced patent box regime. Now, this measure was announced by the coalition government in one of its former budget speeches. And essentially, what the patent box regime envisaged was a concessional rate of tax of 17% on income derived from eligible patents. Now, what the Labor government announced last night is that this patent box regime is essentially not going to be going ahead. The second measure then was the funding cuts, so on the Export Market Development Grants Program. Now, the EMDG essentially is a grant program which helps Australian small to medium enterprises grow their exports in international markets. And it does this by essentially allowing these entities and providing grants to facilitate these companies to market and promote their goods and services on a global basis. So this is an existing program that already exists. What's happened now is that the funding has been cut. So entities applying for grants under this measure are, arguably where they do qualify and they are eligible, the amount of money that they will receiving will be less than what they would have originally received. The next one then is, like I think Todd mentioned earlier, the government will be providing 600 million in additional funding to the ATO to increase GST compliance. So what you will expect here is, the ATO will really be looking at companies and making sure that they are correctly accounting for and remitting their GST, and that they're, the refunds that are being claimed are adequate and correctly ascertained. Also interesting here is that they will be, some of these funds will be deployed to develop sophisticated analytical tools, which would also be used to identify emerging GST risks. Then the other measure, which is the build to rent. So essentially this has a two-pronged incentives, and essentially, capital works tax deductions will be increased, so reducing from 40-year deduction to 25, and also a reduced withholding tax for MIT investments, essentially to encourage foreign investment. And I think with that, we're probably out of time. So if you wanted to go and have a look at any of the other measures, please go and have a look at our website.
Nicola, thank you for that. We do have 1 or 2 minutes left just for questions, and I know there's been a few questions come through in the Q&A that have been raised. Addressing some of them, there were what was also not in the budget in any way, shape or form was a change to the CGT general discount. There was not a proposal to remove refunds on franking credits, other than clarifying some previous government announcements about share buybacks and franking credit amounts. Negative gearing was not something that the budget said was going to be removed. So they were things that were not in the budget. On the superannuation front, curious, there's a few questions that have popped up that I think we've addressed most of them. One is to just clarify that the total super balance, does that include both your balance if you've got some assets in pension phase and also some in accumulation phase? How is that calculated?
The answer to that one is yes. So it doesn't look at whether a fund is actually in accumulation phase or pension phase or what have you. It purely just looks at what we call total superannuation balance. So it disregards any classification, I suppose, of how the underlying monies is classified within superannuation itself.
Yeah. Now, that does draw our webinar to a close. As Nicola said, there's plenty more information on our website, williambuck.com. If you've got further questions, then please reach out to your local William Buck advisor. We thank you very much for joining us on today's webinar. There's a short survey there. If you we'd be pleased if you could fill that in for us to let us know what you found useful in the webinar and what we could do on future webinars. But thank you again for joining us. We look forward to seeing you again soon. Bye for now.